Hey, how's it going, everyone? My name is Amos, and I think I found a hidden gem of a company. Today, we're going to be examining HF Sinclair, ticker symbol DINO, and that's because their mascot is actually a dinosaur. So, year to date, they're currently down by negative 19%. But check this out, their PE ratio is a 7. Yes, you heard that correctly, a 7. The dividend yield is a 4.4%. So, in this video, I'm trying to figure out, is it a delicious or a disgusting dividend stock? And to do that, we're going to be looking at the intangibles, the finances, and we're going to run some valuation models to figure that out. So, right off the bat, the first thing that I want to do is take a look at their adjusted stock price performance to see if it's even worth our time. So, 1 year out, of course, negative 19%. But if we zoom out 5 years, then it's down by negative 1%. And if we do 10 years, please tell me it gets better. All right, a 44% return in 10 years. But what about 20? In 20 years, then we're looking at a 1,500% return. So it passes the first metric and it tells me that, all right, Dino is worth investigating further. But before we go any further, let's go ahead and take a look at their company history. HF Sinclair, what we see today, actually has a very long history of a handful of companies merging. So it wouldn't be fair to just examine Sinclair in this video. Because at one point, this company was Holly. This company was also Frontier. This company was also known as Waynoco. But also, it was known as Sinclair. It's so many different names. So when I say Sinclair, just know that I am giving respect to all of the different companies in its past history. And as you can see on your screen right now, their timeline of their company history, they do call it out as a part of their DNA. I think you get the point. These regional oil companies decided to partner with one another in order to become a stronger business. And I can make an entire video dedicated to mergers and acquisitions, and I think in the case of HF Sinclair, there's pros and cons to their mergers, right? But for the most part, I think it diversified their company assets and it strengthened their operations. Because when it comes to a declining industry such as the oil and gas field, I think if you are a small fish in the sea, it's important that you join forces with someone that's a little bit bigger than you so that you guys can take on Chevron or ExxonMobil. You don't want to be that small guy. And it seems like every few or a handful of years, they acquire another company. Like right here, 2018, the Red Giant Oil Company. 2019, they acquire Sonneborn. 2021, they acquire Puget Sound Refinery. And the list goes on and on. And if we take a look at their footprint, they pretty much operate only in the United States. And when I say the US, pretty much the western half of the country. They don't really have that much going on in the East Coast. So I guess this is their territory. And as of right now, they have about 5,000 employees in total for their company. Now we're going to go ahead and look at some numbers and data. And this is a channel that is focused around dividend compounders. So the first metric that we're going to be taking a look at is their dividend profile. What you see on your screen right now is the free version of Seeking Alpha. I'm way too cheap to pay for this subscription. But anyways, as we alluded to earlier, the dividend yield is kind of juicy at 4.4%. The annual payout is $2, meaning for every share of Dino that you own for $45, you get paid $2 in dividends. The payout ratio is a 29. That tells me that the dividend is really sustainable and there's a lot more room for growth going forward. And when we look at the dividend history, as you can see, there's a gap here in the middle because during the pandemic, this company was going through it. And that's because oil is directly correlated with the economic activity of the world. If everything is shut down and the economic output is decreased or declining, then oil is obviously not going to be a necessity. And as such, they did make the business decision to cut the dividend. However, to their credit, they did reinstate the dividend almost right away. So right before the cut, in February of 2021, they were paying 35 cents every 3 months, every quarter. And then when they reinstated it about a year and a half later, in May of 2022, 40 cents a share a quarter. And they cut the dividend so that the company wouldn't go bankrupt. Because when your finances are in trouble because of a once in a lifetime pandemic, the best thing that you want to do is preserve your capital and start operating in a lean mindset, meaning you got to start trimming the fat, meaning you got to stop spending in areas where you don't need to. And that also includes the dividend. But by reinstating it and having their business rebound, they were able to grow that dividend just as if nothing happened before. When I look at their dividend profile and the numbers, if it weren't for this cut right here, I would give it an A. However, because they did have to cut the dividend in order to save the company, I am going to deduct a grade and say their dividend is around a C plus or a B minus. It's not the best thing in the world, but it's not the worst thing in the world. However, I know now it's in their DNA and in their history to cut the dividend when times get tough. The next metric that we are going to be looking at is the revenue, the top line. What we want to see is the revenue growing year after year. And in the case of Dino, it does seem to be the case, but it does go through cycles, just like every other oil and gas company. But for the most part, it is trending in the right direction. And in the past 12 months, they posted $31.4 billion. Which not bad at all. And this is pretty hilarious. When we look at 2009, they posted $4.8 billion. The next year, they doubled it. And as we fast forward, it kind of goes in the right trend. And sometimes it does go on a dip. But for the most part, it does go in the right direction. And the explanation for why it jumped so high from 2021 to 2022 is because they had a merger. Holly Frontier and Sinclair decided to become one company. And as such, their revenue just increased by a lot. So Dino, as we know it today, we should only be examining them from the 2022 revenue and last year's revenue because that is the new company now. And it does look like they did decline by $7 billion. And that's because with inflation hitting every country and industry as hard as it did, people are slowing down and pumping the brakes. The next metric that we are going to be looking at is the free cash flow. And for the most part, I would say that this is a company that is heavy in cash, but I don't like how they went down from $3.2 billion of free cash flow in 2022 down to $1.9 billion as of last year. But even then, I would say it's still pretty cash heavy. And last but not least, we want to know if the Dino leadership believe in their future, because if they do, they're going to be buying more shares, right? So let's see what's going on. It looks like as of this summer, Franklin Myers, which is the chairman of the board, he did buy 2,000 shares at $52 a share. Right now, they're currently trading for about, $45? So at 52, he thought it was undervalued, which is pretty crazy because a month prior, back in May of 2024, he purchased 6,500 shares at a price of $57 a share. This dude believed Dino to be undervalued at 57. So when it's 45, I would make an educated guess that he's probably going to buy more shares. And then when we look above right here, Vivek Garg, the vice president, it looks like he got 1,800 shares as a part of his compensation package. But for the most part, it doesn't seem to be much insider activity. But it is a good sign to see the chairman of the board thinking that Dino is undervalued at about $54, $55 a share. And now let's go ahead and talk about Dino's business model and how they make revenue. And we'll touch upon if they have an economic moat or not. So Dino is a midstream and downstream oil and gas company, meaning they make money by transporting, marketing, and storing oil, but also by transforming that raw oil into usable products for the consumer, such as engine oil, petroleum jelly, diesel, and jet fuel. And if you watched my video on Murphy Oil, think of it as Murphy finding and extracting oil from the earth as an upstream oil company, and then they go ahead and sell it to Dino, where Dino is going to turn that raw oil into diesel fuel for the truckers. And what I just said right there, that's the life cycle of the oil and gas industry. Upstream to the midstream to the downstream. And it depends on what you find to be more appealing. Some people think the drilling of oil is where the money is at. Other people think the process of turning that oil into a useful thing is more important. And believe me when I say it really doesn't matter. Both sides of the spectrum, very cash heavy margins. And that's why entire countries are willing to go fight one another over oil. It's a big business and a cash heavy industry, which is why future focused investors are are really bullish on lithium and electric powered vehicles, drones, and whatnot because they think that's the next oil boom. The renewable energy sector. Only time will tell, which will also be a direct threat to Dino's business model because they're in the business of petroleum, oil, and gas. And if that becomes obsolete, then their business model is going to be under threat. But unless we figure out a better way to lubricate the bearings and gears and everything that goes inside of an engine, oil is here to stay. Speaking of which, I think what sets Dino apart from other downstream oil companies is that they refine the raw oil into hydraulic lubricants, much like the New Market Company, which is a company that trades for about like $400 to $500 a share. And what you see on your screen right now, by looking at their product offerings, I wouldn't necessarily say that they have a competitive advantage, but by offering products other than gas station fuel, right here, the renewable diesel, if you've ever driven past a Sinclair gas station, I think that's what makes them different from other pure oil downstream companies. Because some of these other companies, they only focus on making jet fuel and vehicle fuel. But when it comes to Dino, let's just click here and figure out. So for the stereotypical downstream oil and gas company, they're mostly refining that raw oil into light products. So gasoline, diesel fuel, jet fuel, and renewable diesel. But what makes Dino special is that they have three other categories, right? They have the lubricants and specialties, Sonneborn, Petro Canada, Red Giant, Holly Frontier. Actually, I have a better, yes, this is exactly what I was looking for. So when you break it down with each one of those companies, they also make heavy duty engine oils, petroleum jellies, locomotive engine oils, tire protectants. So they're really diversified across what they can turn that raw oil into. And what's interesting is that they also turn raw oil into asphalt, which I didn't even know was possible. And I don't know if you're going to care about this, but fun fact, the production side of the operation, their refineries can produce about 380 million gallons of renewable diesel a year, which means that's the limit of how much product they can sell in a given year for now. However, by tuning into their earnings calls and reading their earnings reports, it looks like the company is bullish on being able to produce more diesel as time goes on. So right now, they're able to pump out 380, but in the near future, it should bump up to like 390 million to 400 million gallons of diesel a year, which is a lot. So now we made it to my most favorite part of the video. We're going to run some valuation models to figure out what the intrinsic value for Dino is going to be. This way, we can figure out if it's truly undervalued or not. So the first one is going to be the multiples valuation. Essentially, we're going to figure out a price for Dino based on how the market values their industry peers. So the multiples valuation for Dino, $70.81. And right now, they're currently trading for about $45. Next is going to be the discounted cash flow analysis model, the DCF. And based on their data and numbers, objectively, their free cash flow has been growing at a rate of 144% year over year. But that's not truthful or honest, because when you look at the data, take a look at this. Sometimes it goes down by triple digits, and sometimes it goes up by 4 digits. It's all over the place. And so I decided to go ahead and plug in a very conservative 3%, meaning it's going to grow at a rate of 3% year over year. So taking that into consideration with some balance sheet numbers, the DCF price for Dino is going to be $171 a share. Can you imagine if I plugged in 144%? Let me just show you how bonkers it would get. Then Dino would be valued at $25,000 a share. And that's why it's so important to read between the lines and understand that you can't just go off of what the data here says. You got to understand what's going on. But anyways, the next one is going to be the dividend discount model. The dividend and the growth thereof is going to tell us how much Dino is worth. And objectively, the dividend has been growing at a rate of 9% for the past handful of years. The DDM price for Dino? $70 a share, which I think is pretty similar to, yes, it's pretty similar to the multiples valuation. And last but not least is going to be the Benny Graham's valuation. Warren Buffett really likes this one. But anyways, the Graham valuation for Dino, $65.38 a share. So it looks like the multiples, the DDM, and the Graham valuation are all around the same ballpark. Which brings us to the conclusion. Jimmy, you got to hit them with the drum roll before we reveal how much this company is worth. Oof. By the way, when I do that, I literally slap my nipples, both of the nipples on my chest, and yeah, it kind of hurts. The intrinsic value is going to be $94.37 a share. What do the Wall Street analysts believe Dino to be? Well, Wall Street thinks that Dino should be $64. Now let's see what happened here. What I'm assuming is that the Wall Street analysts are doing their price targets based on a calculation on their grams valuation and the multiples valuation. So, not to copy them, but if we look at our own valuation models and the results, if we delete the free cash flow valuation of $171, because that would be just way too high in an outlier, 65, 70, let's just go ahead and assume 67. And if we include this one, then it would be like a 68. But let's just go ahead and say $67 is the intrinsic value for Dino. Can we all agree on that? All right, so $67 a share. And at this point, after looking at everything, I'm still kind of curious to know what's an acceptable buy price. And in order to do that, we're going to go ahead and bake in a margin of safety into the intrinsic value. So if a 10% margin of safety baked in, then my acceptable buy price for Dino is $60 a share. And if I were to buy it right now, then I get a $15 discount. If I were to say something like, 20%, a 20% margin of safety, then my acceptable buy price is $53.60. And if I were to buy into Dino right now, as it stands at about $45 a share, then I would get a 32% margin of safety. All right, so after looking at everything, the data, the number, the intangibles, and seeing that they're undervalued right now, what are my thoughts and opinions around this company? Well, I think in comparison to Murphy Oil, which I just did a video on and opened the door to oil and gas, because for me, I'm a guy that likes to invest into the future, like what's going to be big and growing in the future. So I never really considered the oil and gas field. However, this past weekend, I was looking for 52-week low companies and trying to find hidden gems, and it landed upon Murphy, and that opened Pandora's box, and it opened my mind up to the idea of investing into the oil field. All that to say, I would feel a whole lot comfortable investing into Dino instead of Murphy. After looking at everything, that's just how I feel. I think Dino has a better and a more compelling story for me. Their trading multiple is just as low at a 7 PE ratio, and they even offer a higher and a better dividend yield. And not only that, Dino's finances and their numbers are better than Murphy as well. So if I were to buy into an oil and gas company right now, based on the two oil and gas companies that I analyzed, Dino wouldn't be the worst idea in the world. And I know this is going to be controversial, I think they're on the border of being a decent dividend compounder and a delicious dividend compounder. I can't say that they're delicious with confidence because they did in fact cut that dividend. And for me, that's repulsive. I take offense to that. But I know they had to do it in order to keep the business alive. It was a fundamentally sound business decision. So I get it. But if you cut the dividend, you cannot be a delicious dividend compounder with cheese in my eyes. However, to give them credit where credit is due, they did reinstate the dividend right away when they in fact found out that their company operations were doing fine during the pandemic, and then they continued to pay that dividend business as usual. So I have to give some brownie points back. Now, since I'm open-minded to the whole oil and gas industry, I think the next companies that I'm going to be evaluating are going to be the big dogs. Chevron, and then ExxonMobil. I don't know, would that interest you? And unrelated to the video, just the other day, I did my first 24-hour fast. I think it was closer to something like 28, 29 hours of no food, just water. And let me tell you, that experience was stupid as hell. I ended up getting sick because apparently when you fast for that long, I'm not talking about intermittent fasting where you don't eat for 14 or 16 hours, but when you go a whole day without eating, your immune system goes into a state of shock and even becomes weakened, in day 2, day 3 during a prolonged fast. So that was probably my first and last encounter with doing a prolonged fast. I think skipping a meal or two a day is probably good if you're fat, and it's just a healthy thing to do overall if you just skip breakfast. But to fast and have no food going in your body and then to get sick for the next week, terrible idea. I mean, of course, that was my own personal anecdotal experience. For some other people out there, fasting might do, magical things, but for me, terrible experience. So I won't be doing it again. But anyways, I hope you enjoyed this video, and thanks for taking the time to watch it. I appreciate you, man, and have a good rest of your day. Stay safe.